This video addresses an important question. How can major investors earn a reasonable yield on low-risk, par-value cash assets? We think the answer is to activate all-to-all liquidity inter-investor at par with market rate commercial paper, mCP. The principal source of high-yield cash has always been non-government term assets. What other practical sources are there? Perhaps non-OECD banks? Non-US prime money market funds? It's difficult to think of others. The reason non-government issuers, especially banks, pay high yields is because they need stable funding. It's what most investors would have to pay if they became borrowers. These cash assets can be sourced directly from either banks or corporations on a bilateral basis. They can also be sourced through a deposit broker. More complex broker deposit structures also exist, such as those used to maximize FDIC insurance, where multiple investors invest in multiple banks. An example is IntraFi. However, none of these options are liquid, and they are only at par at maturity. That being the case, these cash assets are not fungible with the payment system. In the past, banks and prime money market funds as intermediaries could create liquid and par value cash assets. Banks accepted demand deposits at par value. These funded term loans to the non-government sector. Bank liquidity was supported by the Federal Reserve as lender of last resort. Prime money market funds could hold non-government term assets and issue shares redeemable at par. Since the financial crisis and the regulations that followed it, for wholesale investors, all that has changed. Banks can no longer invest wholesale demand deposits in non-government term assets, only in high-quality liquid assets, or HQLA, which are largely government and very low yielding, often negative after costs. Institutional prime money market funds holding non-government assets can no longer redeem at par. Since 2016, they must redeem at net asset value. Investors have been forced into the remaining at par cash assets. Mostly these are government-based and at minimal to negative net yields. This was dramatically demonstrated in 2016 when prime money market funds could no longer redeem at par, and assets dropped by around $1.4 trillion, matched by a similar rise in governments. The objective of these regulations is to prevent further calls on Federal Reserve Board support, as occurred in 2008 and in 2020. They are unlikely to be moderated, and for prime money market funds, they may soon be toughened further. This situation has left an unmet demand for yielding par value cash assets of at least $2 trillion. A new solution is clearly needed. This must provide investors with a liquid par value, money-like cash asset, and a reasonable yield, and non-government issuers, especially banks, with stable term funding. Market rate commercial paper, mCP. How can mCP achieve this? It's been made possible by technology. Unlike other markets, the money market has yet to exploit this. The administration of the money market is modern, but its form, mostly fixed terms and rates, with a handful of other structures like FRNs, has not changed since the Medicis. mCP is itself a term cash asset, but pays a true floating rate of interest. Unlike conventional FRNs, which are benchmarked to other markets, the whole mCP rate floats continuously. As the mCP rate remains at market, the fair market value of mCP is equal to par at all times. The mCP rate is set by a web-based auction of selected CP and CDs, run continuously between de-identified investors. This would be impossible in a paper-based system, but is now quite straightforward. Suitable CP and CDs are being issued already, especially by banks. The mCP exchange runs a perpetual auction for each CP and CD held. Price setting is almost identical to a bond auction. Bids are ranked, and the lowest unfilled bid sets the mCP rate, which in this example is 12 basis points, which is 3 basis points below the 15 basis points paid by the CP or CD held. In this example, Investor 5 wants to return to cash. This is easily done by raising its bid to the 15 basis point maximum. Investor 8 is then a successful bidder. The mCP rate rises to the Investor 9 bid of 13 basis points. Investor 5's funds are returned to the demand account, allowing immediate payments to be made. In this example, Investor 9 reduces its bid to 12.5 basis points in an attempt to acquire an mCP holding, but it remains unfilled. However, the mCP rate does drop to 12.5 basis points, as Investor 9, being the lowest unfilled bidder, controls the mCP rate. What happens to the surplus between the rate received on the CP or CD held and the mCP rate distributed? Firstly, it goes to a liquidity support payment, LISP, and secondly, covers mCP exchange costs. LISP is paid as a bonus rate on the demand accounts of bidders with unfilled bids. The LISP amount depends on the strength of the unfilled bids and is comparable to a put option premium. The LISP payment selectively incentivizes unfilled bidders to provide mCP holders with standby liquidity. But what if all these liquidity mechanisms fail and the market freezes at the maximum rate, for example, in a market disruption? Investors may then take direct ownership of the CP or CD and redeem as provided by its terms, or they may decide to wait until liquidity resumes. So why is market rate commercial paper an advance on prime money market funds? To recap, prime money market funds issue shares to investors and invest in term CP and CDs and liquid funds on demand. But CP and CDs are not all the same. They vary as to term, credit rating, and industry sector. Even more consequentially, investors are not the same either. Investor mandate requirements vary as to credit ratings, diversification, industry, and/or ESG classification, and liquidity. All mandates evolve over time, but liquidity needs can change rapidly and radically. Prime money market funds homogenize assets, including its liquid funds. It's a fair model, but inefficient, as it increases entropy, so destroys information. By contrast, the mCP exchange preserves and utilizes all investor information and rewards resultant bids accordingly. It displays all bids de-identified. Despite the disparities between investors, being an equity vehicle, prime money market funds share the term premium and the liquidity of its assets equally. Whereas the mCP exchange distributes the term premium depending on the liquidity requirements of investors as signaled by their bids and the liquidity support each investor provides to other investors. The mCP exchange is neither a black box nor a blender. It's a fishbowl. The mCP exchange holds CP and CDs in a proven brokered deposit structure. It's secure as investors may take direct ownership of the actual CP or CD at any time. Looks very complex? With modern processing power and the mCP algorithm, it's simple. Starting with the issue parameters, the investor sets its maximum amount and minimum rate bid for that issue. This is repeated for other issues offered. The mCP algorithm uses this issuer and investor data to continually allocate and reallocate individual CP and CDs to each investor, and to set and reset the mCP rate to be accrued for each CP and CD, as shown here. This is done by using well-established methodology to constantly maximize inter-investor liquidity. Bids are then completed in the same way for the full portfolio. Investors then add just one more number, their total investment limit. This must be less than or equal to the sum of their bid amounts. This determines the degree of indifference between the assets on offer. If investors are indifferent between different assets and bid beyond their total investment limit, it allows greater inter-investor liquidity on the mCP exchange. In summary, mCP achieves higher yield by tapping non-government term assets, diversification like prime money market funds, and matches the requirements of each investor. And fully utilizes the available information, provides security over actual CP and CDs, provides more stable funding for issuers, and achieves all-to-all inter-investor liquidity at par with backstop redemption rights. It is also important to note that the benefit of mCP to each investor increases with the number of investors. This results from greater multilateral liquidity. This is a textbook example of the well-known network effect. We should explain our logo. It's a splat of mercury because the Greek for mercury is hydrogeros, meaning water or liquid plus silver or money. This is us. We hope you found the mCP interesting. Thank you for watching.